Okay, now let's look at theoretical bits in budgeting. And then in another video, we will look at kit questions. In this section, we have investment appraisal or project appraisal as well, but we will do that separately than the budgets. Okay, so some of these theoretical parts we have already studied, so I will only explain the bits we don't know. Okay, so first thing, budget. Remember, budget is part of a plan, and when plan is expressed in numbers, they're usually budgets. So budgets could be for 1 year, it could be for longer than 1 year, it could be for less time than 1 year. But the budgets that we worked on usually work for 1 year. But look at the question in exam and see what they are asking. Okay, so there are two main roles of budget. As we know, it is part of a plan. So it compels planning, it motivates people to plan. So when you ask people to prepare budgets, what that will do is it will encourage them to look for the future, and that will encourage them to plan. And then the second part of the budget is that it is a way of controlling. So you give people targets and then you judge them based on that target. So in planning part, we are forcing management to look ahead. Without budgets, they will not be bothered. And through budgeting, we are communicating, especially, for example, if it is a budget made at the top level. So through budgets, communication will be done to the lower level. Or if it is made from the lower level, then through budget, communication will go upward. Coordinate activities. One of the benefits of budgets is that when every department in an organization works, then budget works collectively, like we saw the sales budget, the production budget, the material budget, all of them need to have a link. So by forcing people to plan, we are asking them to coordinate, because without coordination in some of the departments, budgets will not work. And then quantify an organization objectives means it is plan that is expressed in numbers. So sometimes people don't understand words. They understand numbers. Numbers are easier for people to understand. And then the second part of planning is control. We give people target and then we see what they are doing. So that part is the control. We compare budget with actual result. Obviously that will happen when actual period has ended, or maybe we do that regularly. If a budget is prepared for 1 year, maybe we check that every week, maybe we check the performance every month, but mostly it will be at the end of the period in our exams. And then budget provides framework for responsibility accounting. What it basically means is that through budget we give people responsibility, and with that they are accountable for that. So sales department is responsible for sales budget, production department is responsible for production budget. So we give them responsibility and then they are accountable for that. That creates responsibility accounting. So through budgets we know what each department is responsible for. And budgets motivate employees to improve their performance. For example, if you are studying as well, you prepare a plan for your study. If you try to achieve that plan, you will be motivated to work harder in some of the days if you're not studying harder. But without plan, it is you don't usually bother to study. A plan could be, for example, you have registered for exam and you need to cover your whole book, the kit questions and the mock exams during that period. So that becomes your plan. If you haven't registered for exam, for example, it usually takes longer to study. So plan keeps people motivated. And then we could use computers in budgeting. An example of this would be, let's say, spreadsheet. One of the types of budget we have is incremental budget, which is when organization takes last year's budget, they make a few changes, and that becomes budget for next year. If we are using computer system, then it will become very easier to make those changes. We can do what if analysis. What if analysis is when we prepare a budget and we say, what if the units are not as we expect? What if the sales price is not as we expect? This is what is called sensitivity analysis. You will study that in F5. So it is easier to do sensitivity analysis with computer. Now that exams have become computer-based exams, for F5 it is easier to do what if analysis than it was to do in the paper-based exams. So spreadsheets has its benefits, it has its disadvantages. It can be used for costing. We can take the past data and we can predict it. We can calculate taxes, profit projections. And then the cons is data could be corrupted. If you are working on computer file and you don't save the file, or if it is corrupted, your whole data will be lost. Computers cannot calculate qualitative factors. It can give you numbers, but it can't give you words. And minor error could make your whole calculation wrong. For example, in exam, if you're answering, you have entered formula, you have linked one figure with another. If there is a small problem in one of the areas, then your whole calculations will be wrong. If you're doing it manually, then you have to input every time manually. But in computer, what happens is if you input it once and at that time the data is wrong, then the whole calculation is wrong. Then we have flexible budget and fixed budget. We already saw that in when we prepared flexible budgets. So look at that video. Okay, the budgetary process, uses of budget. Why do we prepare budget? What is the use? One thing already explained, use for planning, communication from top to bottom up, coordination, responsibility accounting already explained, control and motivation. All of these we previously saw. And then we have budgets that we already prepared, and then who would be usually responsible for those budgets? Like sales budget, sales manager would be responsible, purchasing manager would be responsible for materials budget. But C in question, who is responsible for what? In F2 level, I would not see that type of especially in variances. There will be a difference, adverse or a favorable variance, and then they will ask you who is responsible for this variance. And then we have budget committees in organizations. In bigger organizations, because budget is a very important role, there are usually committees. What is the role of committee? Remember, role of every committee is being a center point. So the same is the role of a budget committee. It creates coordination. Usually in the in the budgeting process, when one department does not agree with another department, then the budget committee would resolve these disputes. It issues budget manual, which shows the steps of how budgets are prepared, which budget is prepared first, which budget is prepared second. For example, first the sales budget is prepared. When sales information is known, then the production budget will be prepared. When production information is known, then the material budget will be prepared. Timetabling, how much time each budget should take. Provide information if anybody wants to know information about budgets or information about any department, they could ask the committee. And then prepare actual with the budget results, the variance analysis. What is included in budget manual? Explanation of the process, the objectives, organizational structures, how many departments we have, who is responsible for which department. Outline of principal budgets. Remember, principal budgets are the budgets that are constraints. Anything that limits activities of organization is called limiting factor. And when budgets are made, the starting point is that limiting factor. In F2 level, it will be sales department. When we look at our sales, according to the limit of our sales, then we will prepare other budgets. So in outlining principal budgets means which is the budget that constrains everything else. Administrative details, how it is prepared, who prepares it, and procedures. The computer involved, the software involved. Okay, then these are the steps. We've already looked at these steps when we prepared functional budgets. But the first thing is we identified limiting factor. Let's say it is sales. If sales is limiting factor, we will prepare sales budget. After that, production budget, then production resources, then inventory, and then overheads and master budgets. We already saw that in functional budgets. These are functional budgets. So cash budget we also saw. This is the procedure. And then the information that cash budget gives us, we could use that. For example, if it tells us that there is going to be cash surplus means extra. If it is short term, it means for a few months. Then what we will do is maybe pay our supplier earlier, and maybe there is a discount available. Maybe we could increase our sales, and that would be if we can collect our cash quickly. Obviously, if we are making sales and then we are going to receive money in more, for example, money is available for 3 months, and if we make sales and that money is going to be available in 6 months, then it would not be a good decision. Make short-term investments. If we have short-term shortfall deficit, then we could increase our payable. We could ask payable that we will make payment later. Reduce receivable, asking our receivable to make earlier payment, maybe giving them discounts. Arrange overdraft. If we have surplus for long period, make long-term investments. You will see in F9 level these investments. You could make investment in one of these. So at F2 level, you don't have to worry about that. Expand, maybe expanding the building, maybe expanding employees. Diversify, investing in other things. Like Amazon has invested in many things because it had extra cash. Maybe there's a machine that has become old, you could update that machine. If we have shortfall and it is going to be for long term, then we have to raise long-term finance. For example, share capital, or maybe bonds, or maybe we have to shut down because some of our operations will need money for a long period and we will not have that money, so it is better to shut down. Okay, making budgets work. We prepare budgets, but remember, budgets is one part. If you prepare budgets, it doesn't mean that they will be achieved. So budgets needs to have some qualities in order to be effective. One thing is, budgets should not be ideal, which means they're too difficult. If something is too much difficult, then people don't try it at all. and they shouldn't be very low. If it is very low, then it will create wastage, and it creates demotivation because some people like challenge. So budgets should be challenging enough to be motivating, but they shouldn't be difficult to demotivate. So they should be about average. We have these other type of standards as well, like ideal standards, but they are for long-term motivation. So they are not expected to be achieved in short-term. So budgets should be sufficiently difficult to be challenging, not so difficult that it's not achievable. And it should be accepted by employees as their personal goal. What it means is that people believe, employee believe that they are going to be achieved because they are going to be working on it. If they believe it is not achievable, then they will not put efforts into it. So this is what goal congruence means. The goals of organizations and the goals of employees should be same. So there shouldn't be dysfunctional decision making. Dysfunctional decision making is when each department focuses on its own department. For example, production department. Production department would want to produce as many units as possible because if more units are produced, then the fixed cost per unit will decrease. But that creates problem for the sales department, that creates problem for the warehouse. So budgets should not create dysfunctional decision making, which means each manager is looking for the benefits of its own department, because usually their rewards is based on the department's performance. And when rewards are made, that is one of the qualities of reward, that rewards should motivate managers to achieve long-term performance. They shouldn't focus on their own department. And then we have budgeting styles. Budget could be imposed style, which means also known as top-down, which means the top level prepares the budget and they give it to the lower level, and they have to follow that without any question. That happens usually in crisis situation when there is less resource available, there is an option for flexibility, and when employees are not very motivated, then top-down budget will work. Participative budget is when lower level prepares budget and then they send it to the top level for approval. That will work when employees are highly motivated, there isn't any crisis situation, and it creates motivation. Negotiated is in the middle of both. Top level prepares it, and then they ask the opinion of the lower level. In imposed, they don't ask opinion. In negotiated style, they ask opinion. So participative and negotiative has its own benefits, advantages, disadvantages. And remember, negotiated is in the middle of both. So it has some advantages of the imposed, some advantages of participative. So advantages of imposed, it creates coordination. Because in top-down budget, the management says this is what you need to do, and there would not be any disagreement. So the departments should follow what the top level is saying. So it will create coordination. And it usually takes less time because in participative, there will be this disagreement. One department is not agreeing with another department. When it is imposed, then there's no option for agreement. So it has to be agreed. Disadvantages, it can be demotivating because the lower level will believe that it is something that cannot be achieved. A lower level initiative may be stifled. If top level doesn't ask for the opinion of lower level, maybe lower level has potential, and if they don't ask that potential, then they would be covered. And does not suit some employees. Some employees don't like to be told what to do. They They like to be motivated. They like their opinion to be heard. And the disadvantages of imposed is advantages of participative, and advantages of imposed is disadvantage of um, participative. So advantages of participative budgets will be more realistic because they are done by the lower level, and then lower level know what is achievable. Coordination, morale and motivation improved. Increased management commitment to the objectives because they believe it is a budget that they prepared, so obviously they have to achieve it. More time consuming because of the disagreement, and budgetary slack can be introduced. Budgetary slack means uh, managers would try to make the budget achievable. For example, the cost in the budget would be 25,000, but the price in the market is 20,000. The reason management would do that is uh, uh, even if the cost is more than 20,000, it will be still less than the budget, so they will receive their bonus. So this is what is called budgetary slack, making the budgets easier to achieve. It does not suit some employees. Some employees don't ask for opinions. They don't like to be asked for the opinion. They like to be told what to do. Okay, then performance evaluation, when we are looking at the performance of the department, which means according to the budget, like variance analysis. Performance evaluation is a source of motivation. And if you don't do it the right way, it can create demotivation. So when you are giving feedback to your department, for example, variance analysis, they should be clear and comprehensive. It should be easier for them to understand, and then according to details that they can understand. Significant variance should be highlighted. Don't look at the details, the small variances, because if you focus on small things, then it will create demotivation. And give reports on time. If you give reports on time, then what that will do is any adverse variance, for example, it will be corrected on time. And if variance is favorable, then it will create motivation within employee, and then they will try to do much better than that. And then bonus incentives, when we are giving bonuses to employees, or when we are giving incentives to the employees, how should they be designed? One thing is employees should be paid more for productivity. If they are more productive, like we saw in accounting for labor, when employee produced more units, we give them extra for the time that they saved. When organization makes profit, if that profit is shared between employees, then that will create motivation. And then there are other things as well you could do. You could have incentive schemes involving shares. This is when organization tells their employees, this will usually be given to the top level management, not lower level. They will tell their employees that if they work for the company for a certain period of time, then they will give them shares. And usually it will be when company achieves an objective, or it could be specifically giving them shares, or it could be giving them share options. You will look at these in paper SBR, which was previously paper P2. Value-added incentives. Value-added incentives would be when value-added, instead of many units being produced, you could ask your employees if product is liked by the employees. If it had many features, you could give them extra for that many features that has been added to the product, or it could be value added for the whole company. These are the things you will study in paper SBR. And then capital expenditure budget. We already saw the functional budgets and the master budgets. Capital expenditure would usually be included in the budgets, balance sheet budget, um, statement of financial position. It will be included in our cash flow budget. So why do we need a specific budget for capital expenditure? It is something that is additional because usually capital expenditure covers period longer than 1 year. We would be buying a machine for 5 years or 10 years. We would be making budgets to replace machine. Maybe we are making a budget for 10 years or 20 years ahead. So it will not be covered in those budgets that we prepare for year, which is the SFP or the income statement or the cash flow budget. So we need an additional budget for capital expenditure. So if we are buying a machine for a specific year, that will be included in the cash flow budget and the balance sheet budget of that particular year, but obviously it will not cover that whole year. And then they have explained here what is revenue expenditure, capital expenditure. You should already know that from your F3. And then method of project appraisal is another topic which we will discuss in another video after we have covered the kit questions for budgeting.